that is here. We decided not to do any music because Luna is sleeping, and I do not want Luna to wake up because then Michelle's going to be really mad at all of us. So we can't have that. What's happening, Miss Queen, the one and only
Hey, good
Helen Hilton
evening.
Jones? Look at you, man, just setting the world on fire, taking names, kicking butt. What a month! Can we just talk about this a second? What a month she had last month. Um, what a month. 80 something, almost $90,000 written. Just doing her thing. Just doing her thing. Like she's talking about to me, I've got goals, and I'm thinking to myself, I cannot wait to see what these goals are because man, you were shot out of a cannon. She just started dabbling, like, yeah, I'm just going to find out about this debt-free legacy. She's like, yeah, I'm just going to find out about that. And next thing you know, wham, right now. That's crazy. Good for you. I'm proud
Thank
of you.
you.
And I want, so we've got some new folks that are here. And for those who don't know, Miss Helen, she is one of my, I'm just going to call it bestest friends. I don't know whether she thinks that, but as far as I'm concerned, she's one of my best friends. And I think she is just she's a business partner, running buddy. Troublemaker of mine. Just we run into we cause trouble together, and we're just very blessed to have her. She also is one of our advisory board members, and we'll be speaking at conference this October as well. So pretty happy about that. Helen, you had said what you had wanted to discuss today on this, and I wrote it down, and I can't figure out what in the world I wrote down. So I'm going to ask you.
Was it actually was the guaranteed side because I only had one client to ever ask me, okay, explain the guarantee side. So I
Okay,
was kind of like I went blank. But can I ask you one other question? Because I just hung up
you
with Lafayette.
sure you can ask me whatever you
Okay,
want.
so I have one of my pending applications. They just told me that the mother cannot be the owner because he's 24 and
Okay.
this premium is $1,500.
Okay.
So mom is not going to want him to be the owner of this policy because then now she doesn't have control and we was using him as a surrogate. So
Yeah.
now how does that work?
So we're going to have to get a little creative. The easiest way is the trust. That's the easiest way, is because a trust, you never have to worry about that. A trust will, you can actually have anyone that is part of that trust be the insured on that. So that would be the easiest thing. The second thing is, oh, well, we might have to take that one offline just to talk to underwriting
Okay.
because there are a few other things we can do. Like for example, have him be the policy owner, and then after it's funded, you can go in and change it afterwards. It just depends on the company, but yeah, we can talk about that.
Okay. Thank
But
you.
yeah, yeah, absolutely. So today here, there's gonna a couple of things. First of all, let me just get a sense. We have Lisa here, we have Kat, Crystal. I know we've got Miss Lisa Jackson as well, Michelle, Jason, and Jacoya Coco, Jaquan, Drayton the second. So we are going to go over two things that I want to. Helen, by the way, I don't know if you knew this or not, but yeah, Jacoya and I got a new name for her. You know how God's got a certain name for everyone. You know that he knows that name. Well, technically everyone knows my name for her, but that's what it is. It's like we're rolling with it. And every time I see her, I'm going to add one more. By the time we get to Vegas, it's going to be like 37 names long, is what I'm going to have. But I'm up for it. I can do that. So I want to understand our group that we have today. How many of us have written an IUL before? By show of hands. Okay. How many of us have written fixed index annuity before? Okay. How many of us have written an infinite bank concept policy with participating whole life or IUL? Show of hands. Okay. Okay, good. So then this is going to be fun. We are going to first of all, we're going to go through an IUL. Are you talking about the IUL or you talking about the debt-free? Okay, legacy. So let's go ahead and jump into that first. Do you have a something you can share, Helen, or do I need to go and grab that? I probably need to grab that. Not only does she want me to teach on it, I have to come up with a curriculum too. Let's see. Oh, who do we want to use? We'll use one of yours. Helen, let's see here. Let's go ahead and use.
I was about to say I had a lot of them open.
Hold on a second. I know I got, okay. Let's just go to, I'm just going to go to this one here. I think I pulled this up from Antoinette. So we'll go to this one. And then what we're going to, what we're asking about here is Helen said, okay, in the illustration with life, there, no, thank you. I don't want to. I love Adobe. Does anyone else love Adobe like that? Like right in the middle of a presentation, they're just going to start throwing ads in there. Okay, first of all, let's take a look. We will blow this up really big for everyone to see. Okay, and just for some of us new folks on here, the 12 o'clock call Central Time, 1 o'clock Eastern Time, for those people who are right with God, is for brand new agents who really do not understand advanced markets. This is the subject matter expert training, and this is designed for people who have either become subject matter experts and certified, want to become certified, and this is where we dig deep into a lot of this stuff here. Okay, so this is, we're going to be kind of going into the deep end a little bit, into the weeds a little bit. The question that Helen asked is, what is the difference between guaranteed and non-guaranteed assumptions? Now, who wants to take a wild guess about this?
I they're guaranteed to get is what the company or the carrier has, done like over the time that they've been in business. The non-guaranteed is like what they could potentially get, but they don't want to tell them that that is what they will get just in case it doesn't actually happen. But they know that the guaranteed is guaranteed to happen for sure.
Okay, I didn't hear the first part of that because you sounded like Darth Vader. However, I think I got what you said, Jacoya. I think what you said was guaranteed is worst case scenario, and the non-guaranteed is based
Yes.
on the last couple of, whatever the averages that they've been doing. Very different with participating whole life versus IUL. And who is brave enough to tell me what is the biggest difference between the IUL and participating whole life? Go.
That's what I wasn't sure about. Is it because they have a specific guaranteed amount?
Well, let's talk the difference between IUL and participating whole life.
Oh, I thought
What
you was
is the what
going.
is the difference of that first before we get to the guarantee? What is the biggest difference?
They don't have a
It,
dividend.
who don't?
IULs?
What do they have?
They have the compound interest, but they don't give you dividends
Well, how do they have compound interest from what? How do they credit your account?
from your tax fund.
From what? I know you know this, Helen. I know you're
I know
getting
you're kind of confusing me because I know they don't give dividends, so I'm kind of
they
confused.
don't, but
Right.
how does an IUL make their money? How does
Sharon
your
said
IUL follow?
in the chat, is this because of the S&P or is that Michelle?
Who says that?
Is in the chat. It says
There we go. Okay, so camera's gonna be okay. AirPods, bees loud. Oh, I see. Okay, everyone yell and blow your ear out. There you go. Index. Okay, so there you go. What she is saying there is exactly right. The IUL gets credited from the market strategy that you choose. Participating whole life doesn't use the market. What does it use? It uses dividends. A mutual company, basically, when you get a policy with a mutual company, you become part owner. And based on the amount, so let's take a look here. You see this amount based on the $24,000 that you put in, you are going to get a dividend of that. It is not guaranteed because legally we can't say that because they missed 1 year during the Great Depression. So we can't say guaranteed. But if you take a look at the amount you put in, the contract premium, it's $2,000 a month. So how much do they put in? $24,000, 12 times 2. What dividend did they show? By the way, right here, can you guys see that? How much did they make that first year? $2,477. Someone tell me the percentage. Michelle, geez, she's beat. I'm going to have her teach this class. Okay. So roughly 10 to 12% is what the dividends pay out. That's pretty good. Now, here's the question though. This is not guaranteed. So somebody tell me, what does guaranteed mean? What are they going to guarantee? Well, how much did they put in? 2,000 a month. What's the death benefit on 2,000 a month? 349, 961. The only difference over here is these two lines here. Annual dividend, increase in cash value. That's it. So your guaranteed, Helen, is, well, you get the money you have. It just, we're not guaranteeing you the dividend. So the death benefit is still going to be 349. The next year after you put in 48,000, your net cash value, because of how we did this with the base PUA blend, is 4060. So that's where your base and your PUAs, your cash value, you're giving up 18,000 still. But this is guaranteed. Look at the difference. Do you see my cash value first year guaranteed is 13,291? They're guaranteeing that. What they're not guaranteeing is that you're going to get a dividend of 2477. So let's do some quick math. What is 13,291 plus 2477?
15,768.
And there we go. You see that right there? That's your increase in net cash. All this side is doing, Helen, is just adding the annual dividend to the cash value. And because we can't have this mech, we have an increasing death benefit automatically. So if you look, the difference between 349,961 plus what's my dividend? 2477. Now my new death benefit is my dividend plus my guaranteed death benefit. How many
Okay,
people are glazing over and wish they were taking a nap right now?
I have a question.
Yes, ma'am.
Okay, so with you saying that the difference is only the dividend, so I went down to year 10.
Mm-hmm.
So the net cash value was 179,
Mm-hmm.
751.
Mm-hmm.
Okay. And the dividend is 11,868.
Mm-hmm.
That doesn't give me that.
Doesn't give you what?
What the cash value is because when we did
The
the first
net?
year it was the 1578. No, it doesn't
Yeah.
give you that.
Yeah, no, it does because you're adding up all these years. Your net cash value is your total. So it adds every single year. If you were to add this dividend plus this dividend plus this dividend.
Oh, I only
Plus,
added the 11,868. Got it.
exactly. You got
Okay,
to go
I got
all
it.
the way through. It's every year. So this is a growing number.
Okay, I got it.
Okay. And that's why here you see increase in net cash value. Now, you know what's cool is look at this, everyone. In year 12, the way Helen set this up is that the contract premium is going to go down to 9,600 per year. All right. That is roughly $800 a month. Okay. $800 a month, 9,600 a year. Do you see what the dividend is that year? 13,661. Kat, do you know of an investment that you can put in less than $10,000 and make about 140% year over year?
I do not.
That's tax free, by the way.
Definitely not.
So this, look at the, I mean, are you paying for insurance? Guys, I'm going to tell you this. And I say, guys, we have, I don't think, do we have any guys on here? Who do we have on here? We don't. Oh, wait. No, we don't.
Jason and
Wait. Oh, Jason and Misha. There we go. Okay. Okay. All right. Well, we were close. Anyway, so I apologize when I say guys. I actually mean ladies. When you start looking at these numbers and you see that life insurance does not have to cost more as you get older, but it actually costs less, and you are able to build this and customize this in such a way that that happens, you know you're doing it the right way. Watch what happens here at 80. And I asked Antoinette when we did this policy, I said, when do you plan on dying? I think she said 90 something, but anyway, we 86. If you look, she's not putting anything else in this. And let me show you something, not putting anything else in this. Read across here, how much does she still get that year for her annual dividend? 31,774. She's put nothing in. Now you've got a 31,000% increase that year. It's pretty cool, isn't it? And look at my death benefit, still keeps going up. Still keeps going up. She's not putting anything in. She's getting older, and it still keeps going up. Anyway, this is the thing I want to share with you, and then we're going to go look at an IUL, because this is where I wanted to show you guys this. We need to stop. Hey, Teresa, good to see you. Good to see you. We need to stop selling IULs and debt-free legacy, infinite bank. So we need to stop selling it as life insurance. Stop selling a death benefit on this stuff. It's really not necessary. What the death benefit does, and insurance does, is makes it tax deductible because it puts it under 7702-101E 72A. So, I'm sorry, 172E 101A. Anyway, Tamara Tefra Defra. It puts it under that. You do not need to sell a death benefit on this. Does it have one? Yes. Stop selling it as insurance. Start selling it as a safe, effective way to make money and to hide money from tax. That's what we sell this as. Stop worrying about the death benefit. If you sell them as an investment, sell them as this is a retirement vehicle, sell it as what the numbers and math does, you don't have to worry about getting it. Wait, I thought this was insurance. Well, what's the death benefit? Well, that just seems a little less. You get in the weeds with that. And you know what they say? Confused minds don't buy. Confused minds don't buy. Okay. So, any questions on that before we're going to dig into the IUL, because I am going to share with you, and Michelle has had the privilege of hearing this now twice. But I'm going to show you guys how many people. So the IULs, I've had 1, 2, 3 people, 4 people have written an IUL. How many people have heard the two terms properly structured and max funded. Okay? We've heard of that. Now, how many people can tell me if they know how to do that or what that means? Michelle, go to sleep with Luna. Don't. Shh, she's a smarty, let me tell you. Okay, it's a good thing your
I think Michelle
dog.
be great. I think Michelle be great.
So this is what we're going to go over today. What does properly structured mean? And what does max funded look like? Can anyone tell me to unmute? Because I know Michelle can't talk, so who can tell me what does properly structured mean? Oh, I swear I'm going to, how do we get rid of her? Can I kick her out of this thing? All right. Anyone besides Michelle? Go ahead, Teresa.
That's exactly what I was gonna say. Properly structured means that it's structured in a way that for what the client needs specifically. It's not just
There we go.
structured for the
Okay.
agent's need, but for the client.
Okay. So let me ask anyone here a question. Thank you, Teresa. I would love to get more people answering and talking to this. Let me ask you guys a question. If you run across an IUL that was written for $50,000 death benefit, what's your first thought? Was it properly structured or improperly structured?
What was the purpose of the policy?
Okay. What
What
was
was
the
the question?
purpose of the policy? So go on. What options might they have?
I mean, if they got like an IUL for, a younger kid and they were using it for like college, they might be funding something like that, like in a shorter term for like, growth in that way. But I mean, not typical. So I would
Okay.
start looking at those and seeing what they're using, like how long they plan on having it, if it has flexible, like if they plan on upping the benefit later on, kind of things like that.
Okay. So is there a scenario, Michelle, you're going to teach this class next Wednesday, just letting you know. Is there a scenario where the death benefit should be, thank goodness. Okay, death benefit should be all zeros. What would the scenario be? Anyone? Anyone?
It wasn't done right.
That they took money out, they borrowed all their money?
No. If it was so, yeah, not zeros, not like not there's only zeros in there, Lisa. I'm sorry. Like the end, the death benefit, the face amount is all zeros. So it's like
Probably the
50,000.
the agent probably solved for like the face value, like probably went based off.
There we go. There we go. A properly structured IUL is only structured properly at an even number if all they needed was the death benefit and the cash value meant nothing. Now, what would be a scenario where that would happen? What would be a scenario there? When would we use something like that?
State taxes, probate, stuff like that.
Okay.
Like to
When they're
cover.
not looking to build any wealth, they just,
Maybe it's someone who's 75 years old and couldn't qualify for, or who's older and couldn't qualify for term. Final expense was too expensive, but an IUL gave them a death benefit of 150,000 or 100,000 that was more affordable. Right? But death benefit is the only real thing there. So now we're going to get into, so properly structured. I want us to think about this. How many people here own property? Anyone? Who owns Okay. Imagine, if you will, a 5-story building. A 5-story building. Crystal just bought this 5-story building. The problem is she only has enough money every year. She can only finish one floor, one story. and then she'll have someone go in and rent that. Okay. So it used to be Tefra, or excuse me, Tamara told us that we could only do a policy in layers of 5 years, right? Only we could do it in 5 years. So in other words, it would be a mech if I went any faster than 5 years. So I would have to do the first floor. And then the first floor after that year, we got someone rented in there. Then the next year, I did the second floor. We had someone rent that out. Third year. And I'm really not fully funded until all 5 years were complete. Then Crystal's investment is now fully operational and running. Okay. I want you to think of an IUL that way. An IUL, to be properly structured, let's assume that we are selling all of our IULs for cash accumulation and tax advantages, but cash accumulation. Okay. Can we all agree on that? Say, yep, that's what we're going to do. Perfect. Good. Thank you for not arguing. Okay. So we're going to go cash accumulation. And what we're going to do with the cash accumulation is say we're going to try to get as much cash as possible and use uninterrupted compound interest to do that. Now, do we use A or B?
B.
Why?
Say it.
Because it increases the cash value.
Okay. It increases the cash value. Well, actually, A increases the cash value faster. What does B do?
It allows us to put more money in.
No. What does
No,
B do?
B increases the debt benefit, which means that the debt benefit, the cash value gets added to the debt benefit.
There we go. There we go. By the way, Misha, we could have. What's really cool is he left the Golden Gate Bridge and comes over to
Disneyland.
There we go. Okay, so that's what it means. So when you're putting money in there, when you have it as B, your death benefit is increasing. It means the account value is added to the death benefit. Well, why is that important? Well, I'll tell you why. Because if I were to sell Carrie a retirement vehicle, and I were to say, okay, you're going to put money in to this retirement vehicle, and if you ever died early, you would get a death benefit along with your cash. If I did A and she had a $150,000 death benefit and I was cranking in $10,000 a year and we got up to year 10 where she had $120,000 cash in there and she passed away at year 10, she would have a death benefit of, what was the death benefit? 150,000. She put in 120,000. What happens to her 120,000 if she's dead? Insurance company keeps it because the death benefit's 150. That's not an investment. That's a very expensive insurance policy. Right? Versus if it was B, Carrie puts in 120,000 over 10 years. She had a $150,000 death benefit. How much is her death benefit now? Just for simple math, it's 120 plus 150. It's not quite 120, but it's going to be 270. Do you see the difference between A and B? Very, very important that we understand what that is. Okay, so to max fund this, and I hope I don't lose you guys, let me share this out real quick. How many of us are still waiting on National Life Group? One. Really, it's it? Oh, no, two. Michelle's sleeping. Yeah, you're supposed to be. Crystal. Okay, yeah, good. Yeah, we'll get you guys. All right, so we got four of us. Okay. Well, let me show you what you're going to have the pleasure of looking at and doing here. And I'm going to share this out now. Okay. Ooh, look at that, $821,000. Okay, let's see. Illustrations. Let me show you guys what we're going to do here. I'm going to show you how do you max fund something now. First of all, who can tell me? Let's do this. Who can tell me what the Secure Act 2.0 did? Really? Who else can tell me? What did the Secure Act? I'm not going to share this until we can get a conversation going. What did the Secure Act 2.0 do? Anyone? Okay. The Secure Act 2.0 came out in 2022. Changed the regulations of how you could. I notice we're dropping people like flies here. This is getting really in the weeds, isn't it? So it raised the limitation of how fast you can fund an insurance product. Used to be 5 years or 4 years in one day. Now you can get away with it in as little as 2 years. Very, very important. I think very, very important. Why is that? Because when you are trying to properly structure this, and when you're trying to max fund this, you have to know what the max is, right? What's the max? What do I? So who could tell me what is the limit on an IUL? How much can I put in a year? Who can tell me?
Not more than over 10. Is it not more than 10,000 or 7-year payout? Like whatever the policy is in 7 years. Is that what MEC is?
Okay, so you're saying
Whatever
a
the
MEC would be whatever the payment is over 7 years.
yeah, like you can't pay the policy off faster than 7 years. Like 7-year
So there's
payout.
actually a lot of ways to get around that.
Oh, okay.
There's actually a lot of ways to get around that. And we'll dive into 7-pay and guideline single and all of that other stuff. Okay. But here's what I'll tell you. Michelle says 100,000. Go back to bed, Michelle. The bottom line is there is no limit.
Oh,
There is no limit. If this isn't a Roth,
okay.
this isn't a 401k where I can only put in 22,000 now and I have to go to mutual funds or whatever else. Nope, there is no limit. The only thing that has to happen is you have to have a certain amount more death benefit than you do money in the account.
Okay.
That is all it is. And so normally speaking, it's 5 to 7% over the account value. And the cool thing is, kids, the carriers figure this out. They have the actuarial tables to tell. We don't have to worry about it. That's where we're going to go into National Life Group right here and show you what I mean by this. Okay, so we're just going to go very quickly into the death benefit and funding. And I want to show you what I mean. First of all, if you were to, let's say this, who wants to be used as a guinea pig? You know what's funny is I
I
can't see
can.
you guys.
I don't care.
Carrie, okay, Carrie. Here we go. How do I, if you were going to write up an IUL,
Hmm.
what would you do? And I would say I can afford $500 a month.
I can
How would
afford
you
five
write this up?
employees.
Okay.
So, I believe we with Nash, I know with foresters, we had to also keep their income in line, and you just said we don't have to worry about that now, right? So, good question.
All right, let me ask you this. Here's what I'm going to do. Instead of asking Carrie, this is what I'm going to do. I'm going to say, all right, I'm going to do this. I'm going to make this monthly and I'm going to what in the world? I'm going to say we're going to do specify amount. I'm going to say $500 a month. Okay, that's distribution. Forget that. Specify amount, $500 a month. Okay. And there we go. That's what I'm going to do. How many people would write an IUL that way and say it's just 500 a month? And I'm going to check minimum death benefit max cash value. Does that look good to everyone? You guys are all scared to say. Okay, I'll tell you what, 90+%
No.
of the people who write IULs write them this way, and they are dead wrong. So here's what I want to show you. What is 500 times 12? 6,000? Can we all agree on that? Now, here is what I love about National Life Group. National Life Group shows us not only this is the target premium, this is the guideline premium, which is what Kat was talking about. Then we have a 7-pay. And then we have, do you see this max non-MEC premium? What does this say here?
I'm not seeing, are you, oh, I see it now. Okay.
Over on the left side, yeah.
50,000.
Yep, I'm there.
22,150 or 149. So let me ask you a question. What is the max I can fund this policy every year?
22,000.
22,000. And what I did is I checked $500 max cash value minimum death benefit, and I ran the illustration for $6,000 a year. Is this properly structured? I see Kat slowly shaking her head no. So who says yes? There's no wrong answer here, guys. This is how we learn. Who do I have here? I can't see. Oh, Helen. Okay. So I think Helen has her mute off. So Helen says, yes, this is properly structured. It's not really fair because she's driving.
Yeah, I'm trying to see. Right.
This is not properly structured because this person is going to keep contributing. We want to change this, by the way, death benefit to B until they stop contributing. At that point, we lock it in at A. And we'll go over all this, by the way, next week in Oklahoma. There's all kinds of stuff that you're just digging into here. But this is what I want to share with you guys. We are not even close. If this person has $6,000 a year to put in, this is a disservice to the client. Okay? It's a disservice to the client because I'm charging him way more than I need to. Do you see my target premium is $4,049? This is what we get paid for in IULs. This is what we report as our number when we sell an IUL. This is your AP when you do an IUL. $4,049. Okay? So, how do I max fund this? Who wants to take a guess? Oh, come on.
Term policy added?
Oh, what do you mean? What do you mean, Carrie?
If you possibly add a term policy, it will give additional funding for length of time to help fund the IUL.
How?
Or I would be participating whole life. Never mind. I'm on a different thing.
It's okay. Just so we know, Allianz, who we're getting ready to come out with here, I think this week, you actually can build a term policy inside an IUL. So now that means that I have my MEC limit is raised way up. But what's my MEC limit going to do here? Let's go back to this. What's my MEC limit going to do here? If I were to raise a term policy, all that does is means that this gets to go up. If I have $6,000 and this is all I have, how do I max fund this? Helen, what were you going to say?
I was going to say start at level. I mean, our level start at increasing and then change it over to level.
Okay, so that's the first thing we're going to do is we're going to go here increasing, and we're going to say we're going to increase this until age 68. All right, and we're going to pay until age 67. You guys see what happened here? Whoop. What was my target premium just a second ago?
4,000.
4,000 and some.
Yeah. What happened here?
It drops.
Drop down.
Whoa. It dropped down to like a quarter. Is my guideline single still the same? How about my max non-MEC premium?
No, like a quarter.
What was that?
22.
It was 22,000. What is it now?
7,700.
1,700.
7,700.
I'm sorry. Yeah, So 1,700 difference is all I have. Okay. So then what is the best, what if I had, and this is the thing that no one really seems to know, but if I were to write this now at 500 a month, am I writing this as properly structured? How many say it's properly structured now? Okay, Crystal, Carrie, Sherry. How many say, and Natalie, how many say no, it's not properly structured? No one's saying that. Okay, well, here's what I'll tell you. Based on this person, what they need, this is just a retirement vehicle for them. Yes, it's properly structured, but is it max funded? One does not mean the other, kids. Is this max funded?
No.
Who said no? Kat said no. Why, Kat?
Because of isn't it because the target premium is lower? Or the max non-MEC is lower, I mean, like, so you can't
Yeah.
contribute much. Yeah.
Well, basically what it means is it's max funded if the amount of money I can put in is getting accounted for. How much can he put in? 7,700. How much do we show him putting in? 6,000. He's not max funding this. We have to do one of two things. He either has to say, I've got $7,726 a year that I can put in. Fantastic. Then we're going to write it up this way. And instead of putting in 500, you can put in whatever 7726 divided by 12 is, and that's how much you pay. And you can do that every month. What's going to happen is it's going to actually outpace the illustration because there's no way that they've built this illustration to be able to show the increase on a max non-MEC. That's one of the biggest issues that an insurance company does not illustrate that way, which means an insurance company only illustrates based on how it's going to benefit them. Who's confused? Who's confused? Yeah? I can see the smoke coming off of some of our heads here. So here's what I'm going to tell you.
Right.
What's that?
One question on it was an individual, you did increasing B, and that is kind of like a term, or is that something different? Just
No, this isn't a term. This is basically allowing the cash to grow and not being forfeited. That's why they pay you so much more by having it A. A locks the death benefit in place.
Okay, all right, understood. Thank you.
B, yep, B increases it. So here's the deal. If this person said I only have $6,000 to put in and that's it, well then I'm going to need to adjust this max non-mech premium to 6,000. Well, how do I do that? Well, it's just going to be the old-fashioned way. Okay. I'm going to try 400 a month. I bet you if we did 380, oh, we're going to go 390. And let's see what this comes up to. There we go. So 390 is what we write this for. And 500 is what they're going to pay. Do you guys see that? 500. Now listen, how much are we getting paid now? What's our target premium? We're literally, it's only 1,000. We started at 4,400 or whatever it was. We have just taken out a huge chunk of our commission. But is this what's best for the client? Absolutely it is. This is how because if you are only doing and by the way, as it is increasing, if you add that extra $110 a month, it is going to take most of that and add it to the death benefit, which is going to grow that and the cash value faster. So that is how you do a max funded, properly structured IUL. Here's what I'm going to tell you. It is less money to do what's best for the customer. But if we do this with these customers, you are going to get referrals. You are not going to get beat out by performance. Your IULs are going to perform way better than anyone else's out there. And if you come across an IUL that someone wrote 2 years ago, 3 years ago, 1 year ago, I'm telling you, this is like shooting fish in a barrel. You will be able to way outperform anything that they have. Like, this is what my IUL did last year, the last 2 years, last 3 years. If this is how you max fund and properly structure. So to say properly structure, if this is a retirement, what are some of the things we need to understand that must happen? Number one, your death benefit needs to be increasing until contributions stop. When contributions stop, we then make it go to A level. That's what I've done here. We're going to pay the premiums until age 67. At 68, it is going to switch from B to A. And I'm going to show you right now how that looks. Can everyone still see my screen?
Yes.
Good. Thank you, Jaquan. I appreciate that. Okay, here we go. Okay. Let's go to the ledger report here and let me just show you. Now, here we go. Increasing $390 a month. Here's the face amount. Now listen, if someone says, yeah, that's not a lot of insurance, it's only $107,000. What did I say at the beginning of this? What we can't do? What did we tell people with an IUL? How do we sell this IUL? Do we
It's
sell
not
it
a
with
life insurance policy?
forget the death benefit. This is an investment. This is an investment. This is not a life insurance policy. If you start showing people, hey, here's your death benefit and blah, 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 you know what they're going to say? Well, geez, that's not very good. I can pay $4,600 and get a $1 million policy, $2 million policy. This is how it becomes good. You guys ready for this? You see in year 10, how much have I put in, or how much has this person put in? 46,800. You guys see that okay? How's that? Is that better for you, Miss Sherry? Is that good? You see that now? All right, beautiful. Okay. So 46,800, right? Someone tell me how much cash they have in their account.
54,669.
Okay. How much did they pay? 46,800.
Yeah, 46.
How much cash do they have?
54,000.
So they made $8,000 all while paying for life insurance. Now all of a sudden it flips the script. You didn't pay anything for life insurance. You're making $8,000 after 10 years, and life insurance is covered. All right, well, let's keep going. Let's look at year 11. 4680 is what it says they put in. Well, actually, no, they're putting in 6,000. So can you imagine if this was 60, what this number would be? That is the power of max funding. Now, let's just take a look at the 390 a month of 4680 and 4680. They make the difference between 54 and 62 is roughly what? 8,000? Someone tell me what 4680 divided by 8,000 is. You are not doing that in your head, Kat. There's no, you know what? I will gonna have you do this next if you're doing that in your head. That would be impressive. Who's got it? Who's got it? Who's got it? What percentage?
Common Core math.
5.
I was gonna get it if we could.
What were you saying, Jacoya?
You said 46,800 divided by 8,000.
4,680 divided by, please hold, 8,000.
$585.
580. That's what I was about to say.
Okay, 585, which means 41% return on investment year 10. You put in 4680, you get back 8. Kat still doesn't believe me. She's still doing so. You put in 4680, you get back 8. Year 11. Year 11. It gets better. Watch this. This is a 35-year-old gentleman. By the time 67 is the last year he puts it. Do you remember what that death benefit was, by the way? The death benefit started off at 113, right? Now take a look at where it is. This is just a natural byproduct. This is increasing because I want to show you this. His cash value. Someone do this math for me. How much is 559,796 minus 452,262? Who's got that number for me?
It's 107,503,
7,534.
which was
Okay.
was the beginning death benefit.
Say that again, Sherry. 107?
107,534, that was your beginning death benefit at the top when you first started. Yeah.
Well, you look at that. Do you guys see how that works now? Your death benefit plus your accumulation value equals your net death benefit. Your starting death benefit plus your that's what we mean by increasing. So now this person is 67. Well, at 68, again, watch this. At 68, it's at this is your death benefit, this is your cash. Now, let me ask you a quick question. What does this person make in year 34 when they're 68. First year of retirement. They start here. How much do they put in?
0.
0. How much is their accumulated value?
482,226.
What's the difference? Just roughly?
8,000-ish.
How much?
8,000-ish. No, wait. No.
30.
10. Oh, wait.
30,000.
30,000. Yeah. 30,000.
So wait a minute. You're telling me that this person is now 68 years old. They don't put anything in, and their policy made them 30,000? Huh. Well, what about the cost of insurance? Dave Ramsey says is really, 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 really high when you're older. So let's take a look here. 74 years old. Well, 74 years old, I mean, that's going to cost a lot to insure this person this year. Well, how much did they make that year? Well, they put in 0. How much did they make here? Well, let's see. It started at 665, and it goes to 710. That's 45,000. Wait a minute. You mean when they were 74, they made 45,000, and that's net after their cost of insurance? Well, that can't be right, Dave Ramsey, because he says it's the biggest scam in the world. Well, wait. Okay, well, let's look here. Then it's at 84. This has got to be when the policy starts lapsing. At 84, 50 years into it, how much have they put in total? 154,000. That's it. What is their cash value now? 1.354923. In 50 years, this has went up 10 times. 50 years, 10 times. So every 5 years, it's doubled. $1.354. What was it here? 1.271. Someone do the math there now.
83,109.
See, Sherry's on it. 83,000. Well, how is that possible? Because at 84, we still have a death benefit. How can we possibly cover this guy and make 83,000 when he's 84 years old? Doesn't life insurance get more costly?
Not if it's set up properly.
So here's a question for you. How is it cheaper when Scott makes the claim it is cheaper as you get older?
Yeah.
If you do it the right way. How is it possible? I'm going to go back to how is it possible? This is how it's possible, kids. Because, do you see my death benefit here at year 80? My death benefit is 1.102 million. Okay, we all see that? How much is my cash value?
104,9787.
Yeah, so 105, right? So basically, how much more roughly is my death benefit minus my cash value?
52,000.
52,000? So here's how this gets cheaper. Because this person at 80 years old is only covering the cost of insurance for what the insurance company is on the hook for. Well, how much is the insurance company on the hook for?
52,489.
52,000. That's it. They're going to pay out 1.1 million, but you got $1,050,000 sitting there, cash. So the insurance company is only on the hook for $52,000.
Because your money has made dividends or compound interest over the years. What?
All of it.
Language. Okay.
Hasn't made, well, it's an IUL, hasn't made dividends. It's made returns from the market. It's made returns from the market. Okay. So with compound interest, it literally right now, and this is where where I think Dave Ramsey is wrong because he says, well, you're going to have enough money when you do it my way that all you need is term, and then you're going to have enough money. You're self-insured, you won't need it. Well, listen, he's wrong because number one, what happens? Let's say you have $1 million in your bank and I have $1 million in my IUL. Let's see what happens. Okay. Uh, if I got $1 million in my bank, Dave Ramsey's way, and I die, what happens to that money? What happens to that money? Ooh, a lot of people on mute.
Say it again.
Someone. What happens to the money if I've got $1 million in my bank versus so person A, $1 million in the bank, person B, $1 million in life insurance? Okay. Dave Ramsey says, well, you don't need to because you're self-insured.
Person A gonna get
So,
taxed, right?
Oh, the
hey,
taxes.
so
Yeah.
number one, if there's $1 million in the bank and I die, how much does Teresa get?
First, you have to make sure that your beneficiaries or your people can access the money, because if you don't have the right documentation in place, it's gonna take a while.
Mhm. But let's assume I've done that. How much does Teresa get out of my million that I had in the bank?
It depends on her tax bracket.
It'll be based on my tax bracket because it's gonna get taxed, because that'll be as earnings to me, right?
Well, it's a trick question. You're not my beneficiary, so Teresa would get zero. However, I'm just kidding. So yeah, so you would have whatever the taxes are for that year. Yes. So basically, let's call it this: $1 million. If you have $1 million income for that year, good chances you're going to hit about 40%, state and federal. Okay, so that million gets to 600,000. Ouch. Now let's look at my way. That million, how much am I paying on life insurance? Only for 50,000, the difference. And when I die, they get the larger of the two numbers tax free. It is worth that extra. Do you see what I'm saying? The difference there of that? It is worth every penny and beyond because they get 1.1 million tax free. Anyway, I'm way over. I apologize, but this is us getting into the weeds on this stuff. There's so much to learn, so much to unpack here. How many people are coming to Oklahoma next Thursday to see this? Good. Crystal is. I think Kat is. And I think Michelle is as well. I'm trying to think. Poland, are you coming down for that? You're only in Nebraska, man. You're right there. We'll have Poland come down. All right. You'll come down. Okay. Any questions before we head out? Yes, Sherry.
Is there a list of questions to help guide us to identify clients that would be right for ULs? If you probably have covered that before, but
Well,
just pre-qualifying how to direct them to which product investment they should be gearing themselves to.
so first of all, I would recommend to anyone that you have at least 40% of your assets in an IUL, a properly structured, max funded IUL. I would recommend a minimum of that. I would probably say no more than 75% in an IUL, just because I like diversity and some other things. But so again, if you sold it as you don't even mention the name. If I had a way, or if there was an investment vehicle that maintained the three pillars of wealth, what are the three pillars of wealth? Or the three enemies of wealth that we need to have a pillar against? Number
Taxes.
one, taxes.
What was the other one?
Number two, oh, come on, Chicoya, I
Liquidity or
know.
something like that. Was it?
Well, yeah, close. So that liquidity, that's two restrictions. Yeah, liquidity. What's the third one? The three enemies of
Somebody help
wealth.
me out.
Exactly. Risk. Exactly,
It's,
Jacoy. Nice.
that's it. Risk. Okay.
Risk, taxes, liquidity. Those are the three enemies of wealth. What does an IUL guard against? All three. So if I had a way, or I do have a way, this is where savvy investors invest into areas where they do not get taxed, They are not restricted by how much I can put in. And there is no liquidity tax restrict, I'm sorry, and risk. When the market goes down, how many people with my IUL lose money?
0.
Zero. By the way, you guys, Nationwide has just come out with an IUL that actually guarantees a participation rate when the market is negative. First of its class. So instead of getting zero, you're actually getting 3 or 4%. So yeah, that's really cool as well. So anyway, Sherry, that's what I would recommend. I mean, there's a lot of other things too there with it, but don't sell it as an insurance policy. Sell it as this is how savvy investors invest their money.
Well, and asking the question, what do you have, right? As far as
Most people think that they're good. No, I've got a finance guy, I've got all of that. Great. You know who I think is the most proud of your portfolio, Mr. or Miss whoever? The IRS. Because everything you've got is on the front page of that 1040. That's the only problem I see with it. Thank you, Teresa. We will see you shortly. Good people. Okay, guys, listen. Oh, guys, no, all girls now. Says me. All right, ladies. I appreciate what you guys putting up with me today. It's been awesome. Thank you so very much. Crystal and Kat, looking forward to seeing you next week. Michelle, looking forward to seeing you next week. Oh, there's Jay. Yeah, Jason's still there. All right. And that's all I got. We'll talk to you guys later on. If anyone needs me for anything, feel free to hang out here and ask me. I will move over to my office, my MFS office. Okay. So you guys feel free to meet me over there. And MJ, you can go ahead and kill the recording whenever you like.